Revenue versus profit. What's the difference? Revenue versus profit. An overview. Revenue is the total amount of income generated by the sale of goods or services related to a company's primary operations. Profit is the amount of income that remains after accounting for all expenses, debts, additional income streams, and operating costs. Profit is typically referred to as net profit or the bottom line. Key takeaways. Revenue is the total amount of income generated by the sale of goods or services related to a company's primary operations. Revenue, also known simply as sales, doesn't deduct any costs or expenses associated with operating the business. Profit is the amount of income that remains after accounting for all expenses, debts, additional income streams, and operating costs. Revenue and profit both refer to money a company earns, but a company can generate revenue and still have a net loss. Companies report both revenue and profit on their income statement, but they're recorded in different areas of the report. What is revenue? Revenue is often referred to as the top line because it appears at the top of the income statement. It's the income that a company generates before any expenses are subtracted. Income from sales and operations isn't considered revenue if the company also has income from investments or a subsidiary company. Additional income streams and various types of expenses are accounted for separately. Companies often report gross revenue and/or net revenue. Gross revenue is the total of sales a company makes before any returns or pricing discounts. The company then reports net sales or net revenue when these residual sale items are accounted for. Net revenue doesn't include company expenses. It only reports the aggregated revenue factoring in certain aspects of revenue that may reduce the amount. What impacts revenue? Many factors can impact the revenue a company brings in as part of its operations. It can lead to an increase in revenue if a company's products or services are in high demand. It can lead to a decrease in revenue if there's a decrease in demand. Companies must be sensitive to what they charge because pricing is a crucial factor in determining a company's revenue. It can also lead to a decrease in demand if a company sets its prices too high. A company may earn less revenue based on external competition, which can impact its revenue by affecting its market share. A company may have to lower its prices or risk missing out on certain customers altogether if it faces intense competition. The revenue a company earns is also impacted by general economic conditions. Consumer spending may decrease during a recession. This can also be the case for products that are seasonal because a company may simply be at the whim of cyclical demand such as retails during the holidays. What is profit? Profit is referred to as net income on the income statement. Most people know it as the bottom line. Variations of profit on the income statement are used to analyze the performance of a company. The term profit may emerge in the context of gross profit and operating profit. Gross profit is revenue minus the cost of goods sold, COGS, which are the direct costs attributable to the production of the goods sold by a company. This amount includes the cost of the materials that are used in creating a company's products along with the direct labor costs used to produce them. Operating profit is gross profit minus all other fixed and variable expenses associated with operating the business such as rent, utilities, and payroll. What impacts profit? Profit is a component of revenue, so all impacts to revenue also impact profit. Profit is impacted by more factors, however, because there are more items involved in the calculation. Companies may have escalating costs for COGS or other direct costs associated with producing or purchasing the products they sell. It may increase profit without impacting revenue, however, if the company can manufacture its goods more efficiently. Companies are also usually mindful of operating expenses. These are the expenses that a company incurs to run its business. It can increase its profits without having to sell any additional goods if the company can reduce its operating expenses. Companies can also be mindful of net profit by considering taxes and interest. Companies may have to raise capital by offering equity to avoid interest expenses, but this can detract from retained earnings in the long run if investors demand dividends. Companies must do considerable planning, and they must implement legal avoidance strategies to avoid taxes. A company would reduce its expenses in both areas and ultimately increase profit if it were mindful of both, again, without having to earn any additional revenue. Key differences between revenue and profit. Revenue. Money a business earns from operations. Reported near the top of the income statement. Companies rely more heavily on revenue projections when setting expectations. Often less susceptible to bookkeeping variations, and is usually a purer number. Profit. Money a business keeps after deducting expenses. Reported further down the page of the income statement. Companies rely more heavily on profit when deciding how to allocate future capital. Profit projections may rely more heavily on management projections. Most people aren't referring to gross or operating profit when they refer to a company's profit. They're referring to net income, what's left over after expenses, or the net profit. A company can generate revenue, but have a net loss at the same time. One of the primary differences between revenue and profit is where each number is reported on a company's income statement. Revenue is always reported toward the top because it's less inclusive. Profit is always further down because it incorporates expenses. This leads to another key difference. Revenue only incorporates money that's taken in, while profit reflects a combination of inflows and outflows. Companies use each metric differently to make decisions. They use revenue projections heavily when setting manufacturing expectations because they often use forecasted quantities of goods sold as the main driver as to what inventory to create. Companies are more interested in profit when they're deciding how to best allocate future capital. It may decide to invest more heavily into growth if a company expects strong periods of profit. Otherwise, it may decide to build its reserves. Each category is influenced by accounting rules, although revenue is often a purer number that's less susceptible to variation due to bookkeeping. There may be reliance on management estimates and more general ledger account balances when accounting for profit. Profit can be more impacted by accounting rules. Revenue is generally more influenced by market performance.